Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Dhruv Nagarath, Director, Fixed Income Product Strategist at BlackRock. And we're talking about what's going on in the bond markets and whether there are any attractive investment opportunities amid the current turmoil. Dhruv, welcome back. Great to have you with us today.
Thanks, Neena. It's great to be with you again.
So usually the stock market gets more headlines, but this week is different. And for reference, we are recording this on Friday, April 11th. So experts have been focused on the $140 trillion global bond market this week. And in fact, it was reported that the volatility in the bond market reportedly pushed the Trump administration to announce a suspension of the so-called reciprocal tariffs on Wednesday. And President Trump did tell the press that he was watching the bond market and he had noticed that people were getting yippy. So we know that U.S. Treasuries usually serve as the world's safest asset during times of financial market turmoil. And in fact, bonds, fixed income markets, they had performed quite well in the first quarter this year when stocks had a terrible time. But as I mentioned, this week is different. Treasury yields have risen sharply. And there are a lot of theories floating around, investors selling everything to meet liquidity needs, the technical factors, Chinese and Japanese investors dumping treasuries and unwinding of basis rates and even more. And I know that you follow the fixed income markets very closely. So in your view, what's fueling the shift in market sentiment?
Look, firstly, I should say it's definitely been an eventful time in markets and, with the extreme volatility. So I hope that all your listeners are staying sane in all of that. I've definitely been a little bit dizzy trying to stay on top of all the news flow. I don't know about you, but I'm leaning heavily into coffee and chocolate. That's been my fix to stay pepped. But to answer your question, look, the way I think about it, markets provide a mechanism for impounding available information into security prices. And right now we have just a rapidly changing global trade landscape. And investors in the treasury market have been trying to make sense of what that changing policy environment means for growth, for inflation, and essentially how to value US government debt, right? Or put it another way, the US government's future cost of borrowing. The shift in sentiment was fueled by a greater kind of pricing of potential recession risk as well as expected increasing inflation risk. So, we put those together. The term is stagflation risk is increasing. And the rising kind of risk associated with that has created just a lot of there's just a lot of uncertainty around how policy lands. And ultimately that did lead to selling of US treasuries and did lead to the rapid rise in yields that we saw. We saw some of the fastest kind of 3-day moves in decades. And, ultimately there was a pause from US policymakers. And as of today, we're recording on Friday, April 11, we've kind of stabilized around 4.47% on the 10-year. And then the 30-year, the long bond, it's actually up to 4.85%. It was creeping a little bit higher this morning. That's on track for a 44 basis point jump week on week. We haven't seen moves like that since the 80s. Basically, I'd kind of sum it up as investors are very focused on this because of the role that US treasuries play. And you kind of alluded to this, the role that US treasuries play as the risk-free rate that's kind of embedded into the bedrock of the global financial system, right? So that's why there's so much focus on fixed income. We were joking before the call that now suddenly I'm popular again, or apparently what I talk about is of some interest again. But we had a 30-year bond auction yesterday that went remarkably well. It provided some comfort to investors, but then the risks and the fears still remain. And the the word that you're going to basically hear from each and every strategist, anyone in markets that you can talk to, is uncertainty, right? And so I'll try not to overuse it on this call, but it is policy uncertainty. That's what we're trying to make sense of, and that's why even this morning there was a creeping higher in yields. We saw some retaliatory measures from China. So that's what's it's the uncertainty that's kind of like playing through into markets. Interestingly, we also had a CPI reading this week. And it was at 0.1% month on month versus expectations of 0.3%. So that translates to about a 2.8% year on year rate. That's on the core reading. Crazy thing is, normally that would have been a big deal because that's a pretty big move. But indeed, the focus on policies kind of overshadowed that print, and the path of ultimately of US and global trade policy is going to be the key driver that markets are going to watch going forward.
That's a good explanation, and I agree with you that investors totally ignored the CPI report this week, which was a bit surprising. So I mentioned the basis trade earlier, and we have been hearing about the unwinding of the basis trade. And I don't think many of our listeners understand what exactly this trade is. And I read that the market is quite large. So could you explain in simple terms what this basis trade is that is being talked about?
So this is the part of the conversation where if I ever were to try and do this in any context other than markets, I would literally be putting someone to sleep. So I'm going to do my best to try and keep it somewhat interesting, because look, to be frank, it's not something that gets talked about a ton, except when there's a bit more pressure in the market, right? So to put it in simple terms, the basis trade as it relates to treasuries is about exploiting the price difference between actual treasury bonds and the futures contracts that are tied to those bonds. So you've got the same kind of underlying reference asset, right? So what happens is futures typically they are bid higher because they are used more heavily by institutional investors like pensions or insurance companies. And that the reason they use is that those investors are able to get exposure without being fully funded, i.e. they don't have to have the whole dollar allocation associated with the exposure they're trying to get, i.e. by buying, it's like buying stocks on margin, right? Like it's leverage. Because of that, those futures typically trade at a slightly higher price than the underlying treasury bonds themselves. Now, because you've got two securities that are referencing the same asset, well, actually you got so basically the like for like, what you're trying to do is arbitrage, right? So you're trying to capitalize on the difference between those prices, and ultimately to make money off that. Hedge funds will buy the bonds and they'll sell the futures, right? So they'll buy the similar thing that's trading slightly more cheaply, and they'll sell the thing that's trading slightly more expensive. And because of the difference between those prices, I mean, we're talking about the most liquid market in the world. Because of the difference between those prices being so small, hedge funds will use leverage to bid to make those bets, right? And so the basis trade is that strategy that hedge funds are using to wager on the difference between cash treasuries and futures. They'll use a huge amount of leverage to do it. Sometimes it could be 50 times the capital invested or more. You were saying about the size of that market. There's estimates. I was reading something on Bloomberg yesterday that's about there's about estimates of $1 trillion of wagers out there, and that's actually doubled what it was 5 years ago. The reason they're in focus is because of that leverage. What happens when there's stress in the market, or if there's selling, for example, of treasuries, which, as we talked about earlier on, is something that's happened. Those hedge funds that were posting they were posting their treasury holdings as collateral for their leverage. They need to start selling some of that, right? So there's high leverage, high reliance on short-term borrowing. That can, basically, when the economics of that trade get thrown out or challenged, that's when it can create a bit of extra selling pressure and something that kind of compounds on itself a little bit. So I guess the reason that you've brought it up is, you said earlier on, there's a lot of different theories swimming around why treasuries are selling off. One of the theories that's been put forward is maybe a catalyst for some of the accelerated sell-off was that was a bit of an unwinding of the basis trade. I wouldn't say that's the only catalyst, though, based on what I've heard and read, and of course we're all trying to make sense of the same news in some way or the other. But I've definitely heard the theory put out there that that it was a catalyst that could have maybe accelerated some selling.
That was helpful. So let's talk about the performance of bond ETFs amid all this volatility. What sorts of strategies did well, and what sorts of strategies have historically done well during times of uncertainty?
Yeah, definitely. I'd answer this question of resilience in kind of two dimensions, right? So I think about it in terms of how have bond ETFs functioned, and then how have they performed. And dealing with functioning, which is the trading and the liquidity of the vehicle. There's some crazy stories from this month, like in terms of the functioning, right? So the trading's just been spectacular, right? So this is and the funny thing is, this is a familiar story because you would remember back in March 2020 or even a couple of years ago with the regional banking crisis, same story plays out. In periods of market stress, bond ETFs actually trade more and provide a pressure valve for investors to be able to express their views in a fast-moving market. So I'll throw some stats at you because they're staggering. $100 billion in trading volume across the entire bond ETF industry on the 7th of April. That's nearly double the highest day from 2020. And iShares, we had 60% of those volumes. We got a very established and industry-leading treasury suite. That's a big part of it, but also the kind of flagship credit exposures, HYG and LQD, they feature very heavily. And on HYG, one thing I'll say is, last Friday, it traded $13.9 billion. That was a record. And then it broke it on Monday. It traded $14.7 billion. And then another $11 billion on Wednesday. Crazy thing is that this is a $15 billion fund. So that amount of trading really speaks to the very healthy secondary market trading of HYG, and then the options ecosystem around it as well. There's many billions of dollars of options notional being traded around it as well. We saw put buying on HYG as well to kind of make bearish bets. It's a really healthy functioning ecosystem. But on top of that, HYG is the kind of the institutional trading vehicle. It's kind of more buy and hold, broader exposure that goes alongside it is USHY. That's the one that's used more by kind of portfolio constructors. That's also seen really healthy trading volumes. Moving to treasuries, TLT is the one that gets a lot of airtime in the media. It's our 20+ year treasury ETF. That broke some recent records. It traded $9 billion last Friday, $11 billion Monday, $11 billion Wednesday. These are numbers that we haven't seen since 2020, right? And so, but then those are two celebrities, right? I talked about HYG and TLT, but MUB, our national muni ETF, which normally doesn't trade such high volumes, traded $2.6 billion on Wednesday. That's more than 15% of muni market trading on that day. That's the kind of volume that we've seen going through in ETFs. And the overall story is that ETFs have traded more in market, times of market stress, and provided a pressure release valve. The bid-ask spreads on ETFs, broadly do tend to go wider in periods of market stress. That makes sense. There's more uncertainty on pricing. But the great news is that the bid-ask spreads on some of those flagship exposures have maintained consistently around the 1 basis point spread mark. So that's phenomenal to see for investors trying to express their views. Now, the other dimension of resilience in this period of time, Nina, is in terms of performance. And look, there are no surprises here. High quality, low duration assets have done better. Short duration treasuries, things like SGOV, I was looking at earlier on, it's up 1.1% year to date. Another high quality exposures like AGG and MBB are up. MBB is our agency mortgage exposure. Both of them are also up on a year to date basis. I know these are fast moving markets and things can change, but it's definitely been an up in quality trade. Clients are taking down their risk. They're reducing rate risk and reducing the tactical investment horizon as well, just to take time to process where we go from here. But yeah, that's. I mean, I think the overarching story, Nina, is one where ETFs are functioning well, and depending on where how you allocate your risk, they're performing well in the high quality parts of the market.
Yeah, those are some insane numbers, and but these are crazy times, But good to see that more institutions and traders, they're using ETFs to express their views, and ETFs are coming to their rescue. Now, as we mentioned earlier, we are seeing some stability in the market today, but it is not yet clear whether we are out of the woods. And I've seen that markets are now starting to price in the possibility that the Fed will probably likely intervene soon. Do you expect the Fed to take any action in the near future?
Yeah, the Fed is in a tricky position right now. I think the Fed's focus is on its mandates of full employment and price stability. And the overall story, I'd say, is for the time being, the Fed's approach is going to be to keep rates steady for now. Market pricing is signaling, it's varied, but it's signaling 3 cuts this year. We think the Fed's in a very complicated and difficult position, basically, because the central bank has to weigh up the risks to growth, and then by extension the labor market, which is obviously posed by the tariff uncertainty. But it also has to judge the extent to which tariffs may increase inflation, especially in certain segments of the consumer basket. So, like I said, that CPI reading earlier that we got this week, it would have been a game changer because it printed way lower than expected. It would have given the Fed some leeway to cut immediately. But the Fed has made it somewhat clear that they want to see the inflationary impact of tariff policy hit the economy before making any decisions on policy adjustments. At the same time, as we've discussed, longer term rate levels have been extreme volatile and have actually increased meaningfully, right? So that could put pressure on growth and government finances, right, on borrowing. We saw a tax cut bill also go through yesterday. So we have another month before the next Fed meeting. We have to watch the data closely just to see how much economic agents in the economy have paused or are waiting for clarity in terms of business decisions or consumption decisions, and you're seeing some maybe impact on soft sentiment indicators, for example. But presumably, like there's going to be this wait and see approach to making decisions, and so that's what the Fed is caught between. We're also going to be really focused on the next couple of job reports and see how much hiring has been impacted. You'll recall that last week, which obviously feels like a long time ago, we got a labor report that came in meaningfully stronger than expected, with 228K jobs created and an unemployment rate that was kind of unchanged at 4.2%, with solid service sector hiring. So the job market and the economy, we're coming to this from a place of strength, but at the same time, we've seen a bit of a shift in corporate sentiment. So I apologize that there's an overarching theme of the word that I said earlier on that I wasn't going to say so much, uncertainty, but that's what it is, right? And if you see a drop off in hiring, that would make policy choices maybe clearer for the Fed. Like they'd look past inflation to address a deterioration in labor market conditions, but then at the same time they have to weigh up how much does that inflationary impulse from tariffs actually play through. So that's a tricky balancing act.
Right. It seems uncertainty is the only certainty right now. So you explained that we saw investors' preference for safety during the first quarter. You mentioned your SGOV ETF, and I saw that it was one of the top 10 asset gainers during the first quarter. So how are you recommending investors position their portfolios now? Should they continue to favor ultra short-term US Treasuries as a safe haven from the current market volatility, or should they look at extending their duration or taking on some credit risk now?
Yeah, it's interesting. So SGOV has definitely been a phenomenal asset gatherer. I was actually looking at this over the past 1 year. It's grown by $23 billion in assets under management to be a $43 billion fund. And even just this month has seen $3.4 billion, right? So it's definitely been a rock star of this whole experience. And yes, when it comes to what are we recommending to clients, definitely a more cautious approach. But there are some common themes that I would call out that haven't really changed too much from maybe even from when you and I last spoke. I've talked about us liking to we like clipping a coupon at the short end of the curve anyway. Obviously, the short end yields have been moving around a little bit, but it's still a healthy place to be. I think there's still a great opportunity in fixed income relative to past decades. And then also the belly of the curve. So we haven't, and I'm consistent with the past, couple of times we've spoken, we haven't been wanting to take huge bets way out the curve because we are worried about fiscal dynamics, right? And so we want to make sure that we're not taking big bets on duration when you're maybe not fully compensated for term premium. Obviously, recent steepening might change the calculus, and if we get to a point where we're comfortable with it. But right now, we're not taking bets there. So, if I had to summarize it, I'd say we want to own high quality income producing assets, short end of the curve, belly of the curve, and yeah, that's kind of the thrust of it. When it comes to the fixed income, I'm going to speak out of turn and talk a bit about the equity market by just saying that the focus there is also on quality exposures. It depends on your investment horizon, and I'd say in the near term, things like min-vol have been doing well as well. But in a longer term basis, you can tactically you can buy. There's some dislocations that are creating opportunities to buy good quality companies. But I'm going to all right. That's just my quick 2 cents on the equity side. Look, getting back to my sandbox, apart from short duration nominal treasuries, the other thing that I think has popped up into the equation for the first time in quite some time is TIPS. Short duration TIPS exposures. STIP is the ticker there for us. Clients wanting to get the value of that inflation adjustment, but maybe not take duration, right? So STIP keeps its duration around the 2.5 year mark, right? So buying the whole curve that TIP has. But that is something that has seen inflows for the first time in quite some time. I think it's about $1 billion of inflows year to date, because clients are thinking about inflation again. So yeah, keeping duration low, buying your things like your SGOV and your TIP, and then look on the credit side. If you're opportunistic, there's some parts of credit. Obviously, high yield spreads have widened out. Even IG spreads have widened out. There are some people who look at that and say, hey, the corporate sector is actually still it was actually in a good place coming into this. Maybe this creates opportunities, but I haven't seen that level of brazenness in making those bets. I think the big fund that you and I have talked about maybe before is BINC, our flexible income product. That's kind of held up, all right, because you've got you've got Rick Reeder and team actively managing their exposures within that fund, but that is a risk-on spread product, right? So it's going to see a bit of a hit, to prices. So look, overall up in quality, short duration, and to some extent maybe going out to the belly of the curve.
So as investors they favor cash-like instruments so much. We have seen that assets in money market funds, they have surpassed $7 trillion. And because they are almost risk-free and still have very attractive yields. And I saw that BlackRock launched 2 money market ETFs recently. So could you explain to our listeners what exactly money market ETFs are, and then also talk about the two ETFs that you launched?
Yeah, definitely. I mean, it's funny. I was talking to you so much about short duration assets that I didn't even talk about, short duration high quality assets, and I didn't even talk about the most short duration high quality assets that we have now in our stable. So I appreciate you calling it out. Look, money market ETFs are money market funds that are now available in ETF format. This is, if you think about just the growth of bond ETFs, more and more investors around the entire investment landscape, whether you're an individual investor trading on your brokerage account, or you're a financial advisor building portfolios for those individual investors, or you're an institution that's managing money. Across the board, we've seen just adoption of bond ETFs as the preferred vehicle in many, many use cases. And this was a missing piece, was I want to be able to hold true cash in the form of a money market fund, but I want to hold it in the ETF wrapper. And so there was some regulatory change in the past year that has made it easier it's made it possible for ETF managers to bring money market funds to the ETF wrapper. And just by way of background, to be crystal clear for everyone, the very strict definition of a money market fund is that it's a fund that adheres to the strict guidelines of the money market fund regulation under the SEC's Rule 2A7. And it's designed to promote the resiliency and the transparency of money market funds. And it's been modified over time to respond to different episodes of market stress, etc. But the key thing to remember is that both government and prime money market funds must maintain at least 25% of their total assets in daily liquid assets, and then 50% in weekly liquid assets. And the liquidity definition for that is can it be converted into cash within 1 or 5 business days, respectively, for the daily or the weekly. And they're broadly characterized into government, government being short-term US government securities, treasury bills, agency bonds, repo agreements, and then prime funds, which actually can invest in a broader range of short-term debt securities. So it could be commercial paper, CDs, and other instruments that carry some credit risk, but still very kind of conservatively managed. So they weren't available in ETF format before. Something that various investors wanted from us, and we were able to bring it to market. We were amongst the first people to bring issuers to bring it to market, amongst the first few issuers. And we brought 2 to market. So GMMF, very nice and easy to remember, is our government money market ETF. And then PMMF is our prime money market ETF. And the challenge question that I'd ask your clients out there who are holding and custodying assets in different ways is to interrogate how much are you being charged on your sweep, and how much are you earning in yield on your sweep account at whichever platform you're with. These are really cost effective. They're both marketed with a 20 basis point fee, and they have that investor protection of being a money market fund. It's a pretty neat kind of addition to your overall ETF toolkit. So hopefully that gives you a perspective. And obviously, I should say, what are the benefits of the ETF wrapper? You can now trade a money market fund with the intraday trading on the exchange. You can access that liquidity and transparent pricing that's available in the secondary market. And then the key thing I should point out in terms of structural difference is that these do have a floating NAV that is struck once a day at 4 p.m.
Right. It's good that you mentioned NAV. So by my understanding, most, not all, most money market mutual funds, they are required to maintain a NAV of $1 per share. So their shares do not appreciate. Investors receive regular dividends, and that because of the dividends, their investments grow over time. In case of ETFs, of course, investors love the ETF wrapper, and these are very, very cost-effective, transparent, just 20 basis points. But the main difference between the money market mutual fund and the ETF structure will be that the ETF will not have that $1 NAV, but probably the investor experience will be very much the same, right?
That's right. Yeah, it's a very high quality exposure. It's it's when we talk about cash, it's true cash-like exposure. It's been designed to meet those 2A7 requirements, right? So yeah, I mean, that's probably you summed it up really well.
Okay, let's talk a little bit about CLO ETFs, because I saw some interesting moves in the CLO markets also this week. And we have discussed the popularity of CLO ETFs. Last time we spoke, these were very, very popular last year and earlier this year as well. But they have seen some outflows recently. And Bloomberg reported, I think it was yesterday, that the largest product in the space, which is by Janus Henderson, JAAA, that saw nearly $600 million of withdrawals, and which was its biggest single day outflow since fund's inception in 2020. And because of that, JAA, that was trading 1.1% below its NAV. And I should add that we saw some unusual things in the ETF world this week. Even the most popular and most actively traded ETF in the world, and one of the most largest, the SPY ETF, that also closed about 90 basis points above its NAV, and that was its widest premium to its NAV since 2008. And this is very, very unusual. Usually ETFs, particularly the popular ETFs, they trade very close to their NAVs. So tell us what is going on in the ETF, in the CLO ETF space.
Sure. Yeah. I'll focus on the CLO ETF space. I wouldn't make any connection between the SPY functioning and anything to do with the CLO ETFs. There are different quirks that can happen across different markets, especially in volatile markets, and so I just want to keep that discussion separate. And I'll let you maybe invite someone from SSGA to talk about that product as supposed to be. But I was going to say on CLO ETFs as a category in general, and yeah, look, JAAA has been a huge success. We have a competitor product to that, CLOA. Both of these fit into this category of CLO ETFs. What has happened is that more and more investors have been able to access this market. And so what you saw for the past few years was pretty much a one-way direction of flows, because more and more investors were now able to access CLOs in the ETF wrapper, right? And that's obviously a great story when risk is on for the most part, and clients are like looking to tap into some of the favorable characteristics of that market. I think last time you and I spoke, we talked about the benefit of floating rates and the high yields that are available on some of these products. But look, these are bundles of lower quality loans. They've been tranched out. I think that's what we spoke about, the process of tranching and sorting them out into different levels of credit risk. But let's not forget that these are still risk assets in the fixed income risk spectrum. So what we've seen, whether it's outflows from JAAA, which, like I said, it's been a very successful product in this space. I don't think it's causing any particular concern beyond what clients are just thinking about in terms of dialing down risk, right? So you've seen high yield bonds selling off. You've seen IG bonds selling off. This is just another asset in the fixed income risk spectrum that holds some credit risk. And so, there was very much a one-way direction of flows into the product. And so this is probably, to be honest, I don't want to sound flippant, but it's kind of a healthy sign of a healthy ETF trading ecosystem, right? There's going to be times that there's inflows and there's going to be times there are outflows. But to the extent that, the products function well and kind of continue to give clients exposure to their market, I don't see it being problematic. I think some clients might step in and say, hey, I've seen that historically AAA CLOs have not had a default. Now, let's not forget, like in March 2020, AAA CLOs they did fall in terms of price. They fell by about 10%. So you can still have price loss. But then there are some clients who will say, okay, that maybe for me is an opportunity and I'll step in. I'm not saying that's what clients are saying to us right now. Right now, people are still staying risk off. But I guess what I'm saying is that the beauty of markets and the beauty of providing access to these exposures in the ETF wrapper is that you can have a range of market views and you can have disagreement on value. And there are going to be clients that'll trade out and raise cash. And there'll be clients who see opportunities. But overall, I don't see, from what I'm seeing and hearing from our CLO teams, that we're not seeing any meaningful structural issues or dislocations. And then one last thing I'd say on this point, you mentioned discounts to NAV, Nina. One of the things that we learned from the COVID experience, and this is just, I'm not focusing on CLOs specifically, just generally across bond ETFs, we saw discounts to NAV across the industry. 3/4 of the bond ETF industry was trading at a discount to NAV during the March 2020 experience. And the average discount was 2.2%. There were times it was more egregious. There were times it was a bit smaller. But the key thing that we talk about in these kind of markets is that those dislocations in terms of price versus NAV are a feature that's based on the fact that the ETF is giving you an actionable price for where that basket of bonds is going to clear, because you've taken securities that are otherwise traded in an OTC market or largely traded in an OTC market, and you've put it in the really efficient wrapper of the ETF, and you're trading it on the stock exchange. So you can trade throughout the day, you can express a view. And so what's happening in certain markets, we've seen this in IG floaters as well. They traded at a 1.3% discount the other day. You see it a little bit in munis, although they went back to a premium the other day. Is the ETF price is showing you where the direction of price is going, and it's leading NAV, and then NAVs, which are estimates of prices, take their time to catch up in these fast-moving markets.
Excellent stuff, Dhruv. We'll have to leave it there. But thank you so much for joining us today and for sharing your insights.
Thanks a lot, Nina. I really appreciate the conversation. Thank you.
That was Dhruv Nagarath of BlackRock. Let's quickly recap the ETF tickers that we discussed. So we talked about SGOV. It is the iShares 0 to 3 month Treasury bond ETF. And in full disclosure, I own it in the ETF portfolio that I manage. So ultra-safe, risk-free ETF. And if you want to look at money market ETFs, the government money market ETF is also pretty safe. The ticker symbol is GMMF. It is the iShares Government Money Market ETF. If you want to look at money market fund with a slightly higher yield, maybe look at the iShares Prime Money Market ETF. It is PMMF. And if you want active management with a slightly higher yield, then you can look at the actively managed iShares Flexible Active ETF. The ticker symbol is BINC, BINC. We mentioned the dislocations in the AAA CLO ETF. The ticker symbol is JAAA. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.